The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Today I'm happy to be joined by Chris Skinner, famed banking strategist, advisor, blogger, speaker, and all-around good guy. Chris has published multiple books on the future of banking and fintech, including most recently ValueWeb, which in Chris's own words is about the open sourcing of financial services using apps, analytics, APIs, and blockchain. Chris is on the advisory boards of a number of companies, including Innovate Finance, Moven and Meniga. He's been voted one of the most influential people in banking by the financial brand, Next Bank, City AM, Deluxe and Jax Finance. The Wall Street Journal named Chris one of the top 40 Fintech Influencers Globally. If that wasn't enough, Seth Wheeler, Brookings guest scholar and former special assistant to the President for Economic Policy at the White House, called Chris one of the most authoritative voices on fintech anywhere. I've heard Chris discuss the need for real-time, low-cost exchange of goods and information supported by an Internet of Trust, which could be created by distributed ledger technology. Needless to say, we've got a lot to cover today. Check out Chris's blog at thefinancer.com, thefinancer.com, and follow him on Twitter at Chris_Skinner. Welcome, Chris, and thank you very much for joining Rebank.
Hey, Will. What an amazing introduction. Thank you very much.
Yeah, good. Well, we've known each other for a while, and I've probably admired your work even longer. You are, without a doubt, one of the kind of the godfathers of fintech.
Godfather of the fintech mafia.
In its current iteration, certainly, if I'm not mistaken, you've been involved in financial technology for more than a decade at this point.
Probably before you were born. I was starting in the 1980s working with insurance companies and office automation products with a company called Wang Computers. And that was word processing, which was for typing pools, which now you wouldn't even think of having large typing pools producing reams of paper, but back then that was quite an innovative thing to be doing, and worked through other companies like NCR, IBM, Unisys, and in 2002 became independent. And ever since then I've been writing and talking about the future of technology and finance.
Wow, well, your blog is exceptional. You don't need me to tell you that, but
I'm a bit of a nerd, I guess, because I produce something every day, and I just decided that was a way to do it. So,
well, I mean, I've heard people say that writing every day is almost easier in some ways, and every 2 or 3 days it focuses the mind, gives you something to do when you wake up. I've never found that to be true, so props to you. Very impressive. So I have had the pleasure of reading your newest book, ValueWeb, which is mind-blowing, to say the least. You get into a lot on not only kind of where the current fintech boom has come from and what's happening, but also where things are likely to move. And if there's kind of one person that personifies fintech and future banking and future, I think it's definitely you. There are a lot of people that are kind of plugged into what's going on, startup community, some of the trends as they're currently being realized and as they might impact the next 6, 12, 18 months. But I think your view on what banking is likely to look like over the next 5, 10, 20 years is unparalleled. So first of all, thanks for the valuable insight in the book. That was very good.
Yeah, thanks, Will. In fact, just an aside, but a lot of people are talking about platformification of financial services or financial marketplaces and banking as a service today. And I just found it quite amusing because I kind of wrote a blog that got shared extensively in 2009 that was talking about banking as a service and how cloud-based financial services would allow any company or individual to create their own financial structure that suits their lifestyle or their operations. And it took 7 years for it to come to fruition. And I guess that's really because I try and look about 3 to 5 to 10 years into the future based on obvious technology trends. The things you can't predict, though, are the economic and political trends like the Brexit right now, or the global financial crisis of 2008. Because my first book, 2007, didn't mention credit crisis or collateralized debt obligations or any of those credit default swaps issues that we got into in 2008. So most of what I'm doing is really looking at technology and how you can see it emerging into mainstream, and that is predictable. In almost anything like biometrics, video, face services, all those things are now nascent because the technology's reached the mainstream. But it wasn't 10 years ago. But you could see it would eventually come true.
And is that an inevitability based on things like Moore's law, or is it kind of follow the smart money? What are the dead giveaways?
It's obviously from a user experience viewpoint, it has to be intuitively easy, and so the idea of the iPhone was fairly obvious based on the iPod and other things that came before, and combining that with a phone capability in your pocket made sense. And Steve Jobs, and Ives were the guys who made that happen. So some of those technologies are intuitively obvious as intuitive interfaces. But equally, where you can see something that's going to allow you to do things that you've never been able to do before, like connect everybody on the planet through the mobile network, or more intriguingly, something like cloud. And I've been talking about cloud computing in banking for about almost 10 years. And the reason why that was obvious to me is that back in the 1980s, we were talking about why are we building a church for Easter Sunday? And this is the idea that you built your technology to handle the largest crowd that would ever come into the building, which Easter Sunday and Christmas Day may be the days. And that's how we were treating computing at the time, buying the biggest computer we could for the one day where you had a peak. Cloud is obvious in that context as infrastructure as a service, as platform as a service, to be able to give you that capability to just plug and play and use as you need it, rather than buying the whole lot and leaving most of it unused for the rest of the year. So it's really saying, where are these things obvious from a usability, from a capability, and from a cost perspective?
Mm-hmm. I think those are interesting examples, the iPhone and cloud computing. Certainly in the case of the iPhone, you're talking about consumer-driven decisions, so company direct to consumer in an unregulated space. Cloud computing, certainly there's some regulatory implications depending on the industry. I would suggest that predicting future trends in highly structured, regulated industries like banking is a bit more difficult than that, because not only do you have to kind of decipher, interpret technological trends, but also think about how that's going to impact the vested interests, the entrenched players, and how and to what extent new technologies are likely to be adopted across industries in meaningful ways.
Yeah, I guess having given away a little bit about what sort of age I'm reaching, I've been around long enough to see lots of new technologies always saying it's going to destroy the banking system and someone's going to replace the banks, mainly because most of us don't like banks. Even people who work in banks don't like banks. And the reason is that banks control our wallets, and anybody who is stopping us buying and living and doing the things we want because our wallet's controlled by them are not particularly appreciated, but that's what they're there for. They are government instruments of control, because economies thrive or wither based on the capability of their banking and financial system. So whenever anyone says, "Oh, Google, Apple, Facebook are all going to replace the banks," I just laugh, because I've never seen it in the last 30, 40 years, and I don't think I'm going to see it in the next 30 or 40. In the last 10, 20 years, most of the big banks in most economies have got bigger and got more market share of the customers' retail wallets, and have easily bucked off the trends of the assailants. And so what we see happening with fintech right now is you see lots of new startups that initially were talking about disruption and destruction of the financial system. Most of them have either been acquired or merged into the financial system, where they're offering something that's a bank core product. So the Stripes of this world, the Squares of this world, they're not disrupting. They're just making it far easier to use the payment system. So they're supplementing the system. They're not replacing the system. And the only one that really, there's two that come out of the end of this that are doing things that are different, is the companies that are addressing new market opportunities with technology. And those are the companies like Sophie, Social Finance in the US, addressing student loans and support, student mortgages on the basis of Henry's high earners not rich yet. If you're at Yale or Harvard, you're probably going to do pretty well. Companies like Lending Club teaming up with Alibaba and Ant Financial to do a line of credit for small businesses in the US to import from China, which is taking away the difficulties of dealing with borders and cross-border payments and loans. But they're addressing markets that are high risk, and higher risk than the banks traditionally could serve. Funding circles lending to small and medium enterprises, SMEs, which banks don't have the data, the credit history, the knowledge, or the confidence to deal with in the same way. And Funding Circle ends up actually being a government conduit of small business finance, which, or certainly in the UK, that's the way they've evolved. So you kind of have fintech groups that are addressing markets that were underserved or unserved. And then on top of that, you now have the cryptocurrency, digital currency structures coming into play that can serve markets that couldn't move money at all, like sub-Saharan Africa, combining mobiles with mobile wallets and some form of digital currency that's cheap and easy. And so there's new markets. And that's really where I see the fintech landscape now, that you've got the majority of fintechs either working with the banks to make banking easier, or supplementing the banking markets with new market services that were underserved, or new markets that were unserved.
One of the points that you made in there, I think, is an absolutely fundamental one, and you made it in the book as well. It's something that had occurred to me in the past, had never necessarily written about or verbalized, but that concept that despite this kind of enthusiasm for all things fintech and disruption, at the end of the day, the banks don't exist to provide current accounts to the people. They exist to enact monetary policy to support economic stability, government programs, and they're absolutely fundamental to the structure of developed economies. So the idea that a new cryptocurrency is going to be born from one day to the next and kind of replace traditional monetary structures is, I guess, not only, well, I suppose risks sounding a bit far-fetched, but in the event that it, such a thing were to come to fruition, you'd potentially be talking about significant social, economic, political instability.
Well, it's the reason why I always rail against the libertarian dream of money without government, because money was created by governments to control societies and economies. And what we've seen so far in the history of humanity is each time we generate a new form of exchange of value, not just financial value, but bartering or goods and services, whatever it is that we're trading, each time that changes, we add something to the system. We don't actually get rid of what was there before. We add something new. So by way of example, money was created when civilizations formed 10,000 years ago in Mesopotamia, and money was used by the royalty and the church, the religions of ancient Sumeria, to control their society, because an abundance of goods was being produced but not stored for hard summers, and so they created money for that reason. In the Industrial Revolution, we created banks to issue checks and paper notes, and paper became a form of value exchange which we could trust because it was backed by banks that were regulated by governments. Now, what I think is happening is we've moved from cities to cross-border countries and continents through the Industrial Revolution to the network revolution, where everybody on the planet is connected in real time on the network. And so the cryptocurrency and digital currency developments will do is supplement a form of value exchange in real time and low cost for that globally connected system. But at the end of that system, the citizens will probably still use a bank. It may not be the bank as it is today. It may be the digital bank, to store their value, to store their currencies, to store what they see as things that need to have insurance against loss. Because that's what banks do. But the reason they're regulated is they provide an insurance against loss. The FDIC or the Financial Compensation Scheme in the UK, they exist to ensure you can have that trust, that confidence that you're not going to lose the money. And I think people still need that, whether they're using Bitcoin or not.
Mm-hmm. So with the advent of new technologies like blockchain, which, kind of reading between the lines of your answer just now, might be kind of the architecture to support some of these movements in the future, and things like open banking initiatives and PSD2. Do you expect to see incumbent banks, or at least kind of banking in its current incarnation, becoming less core to the movement of money, the management of people's and businesses' financial lives in the future?
I mean, certainly the existing banking structures are going to see their margins collapse, because the margins of profit that were being made on foreign exchange or on credit loans and savings deposits are becoming far more transparent and far more competitive. So banks won't make a lot of money out of the traditional products and services that they've offered. Bearing in mind, though, that you've got a whole other range of services that banks provide that are to their corporate clients, to their asset management services, fund management services, to pension funds. So there's a whole range of other services that we're not really touching on. And again, in a naive view of the world, as a retail view of the world, we think, let's all shift to Atom Bank or to Mondo or to Moven or wherever is ascending. But we forget that actually banks make most of their money from their corporate and commercial and investment markets operations, not really from the retail, although a lot of profit is made in retail. So I think the banks will end up with this open source structure, which you mentioned in the opening, based on back office being based on cloud, artificial intelligence, analytics, deep data, machine learning, along with blockchain shared structures. And blockchain, I should say, it's a pedantic point, but Mr. David Birch, my good friend, keeps making this pedantic point that it should be distributed ledgers. But I normally refer to blockchain because that's what the tagline is for most people. The difference is that blockchain does get normally associated with Bitcoin blockchain, whereas there's lots of other variations of that are distributed ledgers that don't use any Bitcoin blockchains. That's the reason why Dave makes that distinction. But blockchain to me is just a shared database on the internet. And the challenge we have right now in that structure is who's sharing that database. If you're sharing it internally within the bank, or if you're sharing it internally within a government scheme, that's quite easy to do because you control that database, that ledger. But if you're creating something that, for example, will be the next generation of SWIFT for global transactions and currency movements recorded in a trusted way, well, either SWIFT or SWIFT 2.0 has to create that. It's a longer process because you've got 9,000 banks involved, not just one.
One of the questions I ask myself around the advent of blockchain in cross-industry efficiency in enhancing use cases, clearing and settlement, payments. Banks are intermediaries in those spaces at the moment because there's a lot of friction involved in clearing and settlement. It's a question of banks stepping in as a central counterparty between two organizations. Similarly, payments, much easier to go via a bank to make international payment. if blockchain removes friction and removes inefficiency in a lot of those systems, are banks challenged in their ability to step in as intermediaries and extract value by providing a service?
I don't think it threatens banks' business models so much as it threatens central banks' business models. And the reason being is that what's the role of a central counterparty clearing system, a centralized securities depository, a central bank in a decentralized, democratized world? And so that's where a lot of the banks, central banks in particular, are starting to experiment, say, well, how can we have monetary policy that's controlled through a system that's democratized and creating some form of federated blockchain shared database that we authorize the banks to use and connect and become interoperable between multiple shared databases across countries and regions. So right now, I think we're seeing DTCC with digital assets. We're seeing Euroclear and Targeted Securities looking at blockchain shared ledger structures. Mainly, the Bank of England is doing a trial for real-time gross settlement based on Ethereum. We're seeing these experiments because it's creating a new capability of near real-time connections and settlement and clearing, and transparency of structure and trust in structure on a digital platform, which we just didn't have the capability to do before, because before we either had it in a physical context form or we had it in an antiquated form on some form of mainframe computer. And finally, we can see that we can create a secure, private, shared ledger on a globalized basis on the internet that is going to be far cheaper than having it on a mainframe computer in the Bank of England's back office.
So we've talked a little bit about what banking, financial services might look like 5, 10, 20 years from now. How quickly are we likely to see meaningful departures from the current banking paradigm? And are there any challenges to change at scale?
I mean, the area that's most exciting right now is where you see the 4.5 billion people who didn't have any financial service until now getting some financial service because they've got mobile financial inclusion. So sub-Saharan Africa, where 1 in 3 people with a mobile phone have a mobile wallet that's actively used, is showing us a new opportunity to reinvent financial structures. A great example is from the Bill and Melinda Gates Foundation, talking about micro insurances, a bit like the Grameen Bank micro lending structures. Micro insurance could never be offered before, because if you want an insurance policy, you've got to actually be talking of a decent amount of premium payments per annum, and people in sub-Saharan Africa are living on $1 or $2 a day, so they can't afford a heavy insurance premium. But what the Bill and Melinda Gates Foundation is saying is that if you could pay maybe 1 cent a day, just 1 cent a day, and that would give you the confidence to know that if there is a famine, a drought, you can still eat. Would you pay it? And the answer is, for most people, yes, they will. But no one could offer a 1 cent a day insurance policy in the past, but using a mobile microinsurance app, you can. And bearing in mind that more people now have mobiles than toothbrushes or toilets, it's become the key thing as a status symbol for most people to have a mobile. The cheapest smartphone these days in India is about just over $30. And that's a status symbol to have a smartphone rather than just a dumb phone. But even with a dumb phone, you can have a microinsurance, you can have a text payment, you can do things we can never do before. So for me, that's the revolution that we're seeing, that we've got 7 billion people connected globally in real time through a technology network that can exchange value, and that value exchange doesn't need to be through a bank. And for 4.5 billion people, it won't be. It'll be through some form of mobile wallet service. And that, when that comes to fruition, we'll need mobile identities to go with it. And if sub-Saharan Africa, Philippines, Indonesia creates digital identities on mobile wallets, do you really think we won't be using them everywhere else? Because they're going to be cheap, they're going to be easy, they're going to be secure and trusted. So, give it 5, 10, 15 years, we're going to have a digital identity scheme globally that's standardized, and I own it. And that's something that I can then give permission for governments and companies to access. And that's going to be a far better world, because that means that I control my identity rather than someone externally controlling my identity. One of the key things that's come up recently is the United Nations working on a program to give every single person on the planet an identity scheme, a digital identity scheme. And the reason why they're doing it is that 1.5 billion people don't exist on this planet because they never had their birth recorded. So those 1.5 billion people can be trafficked as humans, they can be sold as sex slaves, they can be put into imprisonment. No one knows because they've never actually been identified as being in existence. That's a problem that the United Nations has set as a goal to solve by 2030. And they're working with shared databases, mobile wallets, and biometrics to make that a realizable dream. If that's the dream that they realize, we're all going to share that dream.
So you would expect that to be a publicly led initiative? Certainly in the developed world. In the developing world, it sounds like there are a number of projects in the developed world that look to do similar things in a private sector led way.
Yeah, I mean, there's quite a few blockchain and distributed ledger startups in the developed world that are looking at digital identities and KYC. They're coming at that from a different angle. But if UNESCO, Bill and Melinda Gates Foundation, the World Bank, United Nations all collaborate to create some form of public key infrastructure that can support a digital identity scheme effectively, then that will be intriguing. Now, again, the challenge here goes back to how do you make that work? Who's issuing the identities? How can you trust the identity schemes? Can the banks leverage those schemes? So there's a whole raft of other questions to be answered. And that's the reason why we've never had an effective scheme across borders before. But I think we're getting there. I mean, I was just blogging this week about use cases in distributed ledgers, trade finance being a key one. And there's a company, in fact, there's several companies like SkewChain and Wave in trade finance that are allowing developed economy financial institutions lend to developing and emerging economy companies that don't have the trust and reputation that you need for traditional lending, but they do if they have a reputation established on a shared ledger structure that's approved and authorized by the schemes that are working in that trade finance structure. So again, you're starting to see lots of innovation around inclusion, around verification, authentication, identity that we've never seen before in such an explosion of creativity.
You mentioned the point around data ownership, identity ownership, when it comes to new structures in which identity is maintained via a distributed ledger system. There's been, it seems like an increasing amount of interest and an increasing amount of work recently in kind of thinking through new ways of data ownership that differ from the kind of the Facebook Google model that's prevailed in the past few years of a handful of large technology companies owning everyone's data and kind of pushing data ownership back to the individual user. I was reading about a company, I think coming out of MIT, called Solid, which basically looks to give each individual their own, effectively, data file structure that they can host wherever they like, publicly, privately, and control and grant access to certain pieces of that to certain online platforms. Facebook may get a slice, and Google may get another slice, and your bank may get a third slice. Do you think that's a likely trend to continue? Do you think kind of the question of data ownership is an important one, and how and do you think it might change significantly if we move to a more blockchain based society?
It's a key question, Will, in that right now there's an argument raging in the States around access to customer financial records. And the argument goes along the lines of banks saying the only person who should be able to access their data is the customer. And the reason being for secure purposes. If you allow third parties to access customer financial data, they could compromise that data. If the lobbyists for the big US banks win that view, then all the fintech in the US and all the aggregators in the US go out of business because they're using access to customer data as their business model in most cases. In Europe, as you mentioned PSD2 earlier, you've got open API access to customer data. You've got the Competition and Markets Authority here in the UK just saying that banks must give access to third parties for usage of customer data. So the question really is, who does own the data? And if you say it's the customer, then it needs a new structure, because right now the reason why you've got an issue with the US lobbyists for the banks on who owns the customer data is that if they win that one, then it's not the customer who owns the data, it's the bank who owns the customer's data and allows the customer to access their data. And that's the problem. And that's where I think we also have a problem with Google and Facebook, in that we've sleepwalked into Big Brother, because we've let the large internet giants take over our identities and our memories and store all that information at their disposal. Now, we've seen the European Commission and Parliament have big bust-ups with Google over the information that they keep and store, and equally the right to have myself undone on the search engines if you can find me on a search that I no longer want people to be able to see. For example, if I was found innocent, the fact that I was in court will stay with me forever on Google. I get that perjured now. But it really comes down to the model that we have to work to, and again, it's going to be a long time getting there, but it is that model where the customer has ownership of their identity and their data, and can, on a permissions basis, allow corporations and governments to access that data. And the reason why they'd allow is that if they want to travel, they have to allow borders and governments to access their identity information. If they want to get $15,000 transferred from the US, they have to allow the bank to access their data. But it's the other way around. Rather than the bank allowing me to access my data that they own, it's me owning my data and allowing them to access my data that I own. And that's what we have to get to. And that is a different structure. In fact, it does mean, we've seen a lot of technology companies disappear or almost disappear in the last 40 years. I mentioned I work for Wang. They don't exist anymore. Microsoft almost stumbled and luckily got the mobile spirit back and came back. IBM almost disappeared in the 1990s till Lou Gerstner turned them around. So the reason for that is that Google, Apple, Facebook, Amazon, Alibaba, Baidu, none of these companies are immune to the changes and the forces of change that we're discussing here. And particularly that data one, and I own the data, is going to be one that could compromise all of their business models if they don't keep up with the changes.
Sticking with the topic of open APIs, but bringing it back to banking and to what's kind of what we're seeing at the moment in the UK and Europe. Fidor Bank in 26, Mondo, based on their guidance in terms of what they're expecting to do, kind of the bank as a marketplace. What are you seeing that's most exciting to you at this point? Which players do you think are most likely to make the biggest strides early on and gain market share?
I mean, there's too many startup neobanks in the UK in particular. There's some like about 40, and there's some that even I didn't hear about until they announced, like Tide, which is one of the newest ones, because they're in stealth mode. When you've only got 5 big banks in the UK and you've got 40 that are trying to get a slice of their business, not all of them are going to get there. So some have to have differentiation and some have to have more focus. And quite a few of them seem to be narrowing where they're trying to be. I guess the only two I'm going to mention, because I like the people and I like the discussions I've had with them, is Loot and Solaris. And the reason I'm picking them out is that they're two very different ones. They're not trying to be a mainstream retail digital bank offer or platform. And Loot in particular, for example, is led by Ollie Purdue, who's a 23-year-old former law student from Manchester University who dropped out to create a bank. And you don't normally hear that from students. And I asked him why the hell he thought he could do it. And he said, well, because when he was at university, his bank app didn't give him what he needed, which is, like most bank apps, they tell you what you spent. They don't tell you what you're going to spend, and they don't tell you that you might have trouble if you do what you're about to do, because in the next week here's your outgoings, and you're going to have problems. So Loot is all about creating a cash flow management system for millennials that's visualized, fun, engaging, and at the same time gives you your warnings before things happen rather than after they've happened. And the reason why you don't get that from a bank is that a bank's just got an automated branch-based system in their app, which is therefore just a balancing and transaction system. It's not actually something that's going to be engaging or forecasting for you. And Loot is getting its audience through word of mouth. Their average onboarding cost is £1 for a customer, and if you look at most banks, you're talking at least £1,000 or $1,500 to onboard a customer. So £1's pretty good, but they don't actually act as a bank because Loot is the user experience customer interface, and Wirecard, which is the German bank, is actually the license holder for the moving funds. And Wirecard's pretty good. That they are the bank behind Holvi. And they've been doing quite a lot of interesting visionary stuff, which kind of brings me to Germany because you've got Wirecard, you mentioned N26, Fidor, and Solaris is another German bank. And the reason why I'm mentioning them is that when we talk about APIs and apps, 20 years ago we were talking about object-oriented architectures, and IBM had the SEO service-oriented architecture. The whole idea was that we would break down everything into modules and components of process and then make that plug and play. And that's basically what APIs are in a modern world of widgets. So there's some banks like Privatbank in Ukraine that have broken down all their services into APIs and apps and now offer that as a technology company to banks worldwide. Solaris are a company that's basically said, we'll offer all the bank capabilities you need in a widget form, and their customers are fintech startups. And the reason why they're fintech startups that are their customers is that quite often a fintech startup might have a checkout API payments capability, but they don't have savings, deposits processing, credit structures, or card structures, or other things that they might need. So they can just pick from the smorgasbord of things that Solaris offer, the little bits that they need. And that's a really innovative model. Again, it's different. So Loot and Solaris stand out. And it's not to denigrate the others like the Atoms and the Mondos and the Tandems or others that are doing amazing things too. It's just to say that I like those two because I think that they show a clear niche focus. And you need to have that clear niche focus because none of these startups are going to actually be challenger banks, because to challenge the big 5 banks in the UK, it's not going to happen.
No, I think that's a good point. And the two banks, air quotation marks here, in that Loot isn't a bank, and they don't have a banking license. But I think that in of itself is a good point. Even the kind of the definition of a bank going forward may, at least in colloquial terms, change. The bank is, I guess, who you interface with to store your money, move your money, in the event that you need a loan, access your money. But here you've got two dramatically different business models. One which looks to interface solely with customers and not do so much with their funds in the background, and the other which seeks to serve as a platform, take deposits, presumably find some profitable way of managing those deposits, but not interface with customers. And I guess two questions that brings up, and maybe start with one and then move to the other because they're not intimately related. But I guess the first question would be, does that suggest that going forward we start to see kind of a proliferation of niche business models, to use your words, which differ from the traditional industry structure which we've seen, which has been basically a bunch of homogenous banks all looking to do all things for all customers?
Well, I mean, Loot tell me that they've been approached by most of the big banks to try and work with them. And the big banks come in and say, look, we've got scale, we've got capital, we've got customers. And Ollie's answer is, you've all got that. That's not what I need. What I need is someone who's got imagination. And so that's a key part of this. And what I think is going to happen is the end game is banks, the incumbent banks today, become what I call value systems integrators. So they do become technology companies. I mean, they already are technology companies. Some people say that incumbent banks are fintechs that are just very mature. And being a mature fintech, you've got an awful lot of heritage that you need to renovate and renew. And over the next decade, through APIs and apps and analytics and machine learning and cloud, we can do that renovation and renewal of these mature fintechs. And that's why the mature fintechs become value systems integrators, because what they end up doing is component by component, piece by piece of their existing operations is replaced by a fintech partner or a development that they do internally that copies something that a fintech's doing, or by acquiring a fintech to fill that gap. So that's already happening. BBVA is leading example of that with the acquisition of Whole, the investment in Atom, acquisition of Simple, etc. So a bank renews itself by fintech partnering, acquisition, and imitation. And what they end up being is a integrator of hundreds of thousands of components, because as a customer, I don't have the time to deal with hundreds of unbranded, untested, unproven startups. I have no idea whether I can trust them or not. But I trust my bank. So why doesn't my bank integrate those hundreds of startups that are relevant to me and offer them to me, and then I can use them? And that to me is a far better long goal for an incumbent institution to say, look, we're going to be like an IBM, or in technology terms, we're going to do that in value and financial terms. We're going to be the best systems integrator of technologies to give the customer experience, the proof processing in real time, and the secure storage of what you value.
That's actually really interesting, and it kind of leads us nicely into the second question, because the thought that kind of leaps to mind based on that response is, at the end of the day, it almost becomes a question of where's the value to the bank, as in where's the revenue, where's the profitability? Is it traditional interest margin on deposits versus loans out? Is it on the payments that you're doing, on the direct to customer access to funds? I don't know. Is it advice? Is it investment advisory? Because it seems at the moment like the value currently earned by banks is starting to be fragmented a bit between incumbent banks or other institutions seeking banking licenses, which will focus to an extent at least on net interest margin, and fintech companies without banking licenses, or at least those more geared around the front-end customer experience, that are deriving revenues based on movement of money, financial advice, support in reaching savings goals. Which brings back to the question I was going to ask before, which was, is the banking license still important? Do financial institutions need banking licenses in order to secure viable businesses over the long term? Or is it now a perfectly good solution to work with someone like Solaris Bank, focus on the user interface, earn some fee revenue without actually taking deposits?
The key here is that you've got large banks globally that are dealing with millions of customers and billions of transactions that are regulated and trusted and have a proven counterparty operation structure that works. So that will take a long time to disappear. And particularly for corporate, commercial and investment banking and transaction banking, that's a structure that will be in play for probably the rest of my lifetime. Where the fintechs are making impact is on squeezing margins, because most of the focus is on doing these things better, faster, cheaper. And if you are better, faster, cheaper, then you've got a differentiation against the incumbent, but then you've got to get an audience. And so getting people to use better, faster, cheaper is part of the challenge. I kept saying to banks like Fidor that I really love what they're doing, but they've only got 100,000 customers. Whereas, if I look at the UK banks like Lloyds, you're talking 30 million customers, a massive difference. And Lloyds has time to convert and keep up and catch up, because those customers don't switch. They're lazy. They don't see banking as important, and so they're not going to move around much. So how do you get an audience as a neat, nimble, better, faster, cheaper startup? That is the critical question. And then by the time you get to be big enough to be credible, like Fidor, you get acquired by Group BBC in France, so you disappear anyway. So it's really that we are going to see banks move away from their existing product lines and margins, particularly in retail, because of the squeeze on those margins. They're going to have to be pared back. So at some point, if I see TransferWise advertising one more time that they're free almost compared to banks, then I'm going to end up using them, because I'm going to go, well, if they're free, why am I using a bank? So that's where the margins will get squeezed. And what banks then have to do is to become, if they're value systems integrators, far more savvy in creating a personalized one-to-one relationship through digital devices and digital reach. But we're missing one key point, is that we're talking about the here and now. In a few years, the Internet of Things takes over. And at that point, I'm going to have smart TVs and smart cars and smart homes and smart clothes and smart watches and smart everything transacting and exchanging value on my behalf, authorized by me to do that. And at that point, if you're thinking about all those devices transacting on your behalf, then that means that the current transaction volumes in the network today are going to explode, maybe tenfold, maybe 100-fold, because everything's transacting non-stop in real time, not just the 7 billion people, but their devices. That means it's 50 billion devices or more transacting all day long, 24/7 as well. And the value of those transactions is going to be maybe 10 times less or 100 times less than the average transaction value of today, because it's not me doing something on my mobile app or with cash. It's my TV ordering Game of Thrones Season 9, and maybe paying for the minutes that I watch on a 1 cent a minute basis. And at that point, that transaction structure, that massive explosion of volume, but massive decrease in value, is going to be intriguing to see what that does to the financial system, because that's going to be yet another evolution change. How we do that, who's doing that, what technologies are being used to do that is still unresolved. And shared ledgers is definitely going to be a key part of that, because it has to be low cost, real time, almost free.
Well, there's almost a whole other podcast right there.
The Chris Skinner interview part 2.
There we go. We may have to do that at some point.
Or read the ValueWeb, because it's all in there.
Perfect. Well, there you go. Chris, thank you very much for making time today. Great to have you on. Great to chat as always. Any parting thoughts you'd like to leave with the audience? Certainly where they can find out more about you, contact you, where they can buy the book.
Yeah, thanks for inviting me in, Will. If you're in Europe, then try and visit the Financial Services Club at some point, which is meeting regularly in London. fsclub.net gives you the view of all of our clubs across Europe. We operate in 8 countries. And then the financer.com that you mentioned at the start, TheFinancer.com, is where I blog every day. All the books can be found on Amazon or wherever you prefer to use. And the newest one is ValueWeb, which is why this financial system is changing dramatically thanks to fintech startups, and specifically based around shared ledgers and mobile technologies. And the previous one is Digital Bank, which is how to launch or to become a digital bank, which is actually more about the how. So ValueWeb is why banks must change. Digital Bank is how banks will change.
Great. Well, I could definitely second what you're saying about ValueWeb. You go very deep into what's likely to develop as we start to live in an Internet of Things connected world, and what the impact will be on banking and financial services. Chris Skinner, thank you very much.
Thank you, Will. See you again soon.
Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.